MercadoLibre just dropped almost 16% in 3 trading days. And this is not a small speculative company. This is MercadoLibre, one of the strongest e-commerce and fintech platforms in Latin America. So the question is simple. Did the market just create a buying opportunity, or did earnings reveal a real margin problem? So here's what happened. MercadoLibre reported Q1 2026 results. Revenue was extremely strong at 8.85 billion, up 49% year over year. And that was better than expectations. But EPS came in at $8.23, down from $9.74 a year ago, and operating margin fell sharply. That is why the stock sold off. Investors were not rejecting the growth story, they were repricing how much they are willing to pay when growth comes with margin pressure. If you like breakdowns like this, subscribe to FinanceToGo. The goal here is not to chase every headline, it is to figure out which big moves actually deserves some more research. So what does the company do? MercadoLibre is basically the Latin America of the Latin American e-commerce and fintech ecosystem, you could say. It has the marketplace, MercadoPago payments, credits, ads, logistics, and merchant tools. That is why the business can grow fast, but it is also why margins can move around when the company invests aggressively. So the headline was great. Revenue up 49%. The reality was more mixed. Earnings and operating margin moved in the wrong direction. The market is asking whether this spending builds a bigger moat or whether it means future profits are less certain than investors thought before earnings. So, did the numbers justify the move? The numbers justify concern, not panic. Revenue was 8.85 billion, up 49%. That is a real growth signal, but EPS was $8.23, down about 15.5% from last year. Net income fell to 417 million. Operating income was 611 million, down from 763 million, and operating margin was about 6.9%, compared with roughly 12.9% a year ago. So this is not a broken company, but it is a messier quarter than the revenue headline alone suggests. Let's take a look at the price chart. On the chart, this was a fast reset. The stock went from around $1,870 before the reaction to $1,578 in the big mover screen. That removed roughly 14.8 billion of equity value. A move like that gets interesting, but only if the new price gives enough room for the margin risk. After the drop, I would put the rough fair value range around 1,550 to 1,950. That is wide because MercadoLibre is still a high growth platform, but margins are harder to underwrite after this quarter. The setup gets more interesting below roughly 1,450 to $1,550. At around $1,578, it is fairer than before, but not obviously cheap. So, is it a buy after the move? My answer is it's worth researching after the drop, but not a blind dip buy. The business quality is still attractive, the revenue engine is still real, but the sell-off happened for a reason. I would want to see margins stabilize, credit quality stay controlled, and the company prove that the spending today turns into stronger earnings power later. So what to watch next? The next few quarters decide this setup. Watch operating margin, EPS growth, fintech credit quality, and whether commerce growth stays strong. If those improve, the sell-off could look like an opportunity. If they do not, this could just be a fair repricing of lower near-term profitability. So comment below, was MercadoLibre's drop justified or did the market overreact? And tell me which big mover you want FinanceToGo to analyze next.